How to protect your mutual fund investments in volatile stock markets. In the video, The Miracle of Compounding and the Dynamics of Leverage, we illustrate that with just a modest 2% monthly enhancement, investors can build substantial wealth even while experiencing serious adverse market downturns. Rather than focusing solely on downside protection, it can be even more effective by just to grow the investments a bit more, but do so reliably with intelligent strategies. This is not a new idea. It has been practiced and proven. Successful investors typically are willing to accept slightly higher risk in order to grow their investments faster. The key principles are, first, to grow, and second, to grow faster with controlled risk. At Quantum Edge Investing, we believe mutual funds are excellent long-term core holdings. Over time, disciplined investors can accumulate substantial wealth through mutual funds. This naturally leads to the next question: how can I protect my mutual fund investments in volatile stock markets? A quick internet search results in many typical advices, such as Investopedia's 6 Ways to Prepare for a Market Crash. Commonly cited strategies include: 1. Diversify by holding a mix of stocks, bonds, cash, real estate, precious metals, and other assets. 2. Fly to safety by shifting equities into cash or cash equivalents. 3. Seek guaranteed returns by using CDs or other fixed income instruments. 4. Hedge your bets by shorting stocks or buying put options. 5. Pay off debt by reduce high-interest liabilities. 6. Use tax loss harvesting by offsetting gains with losses for tax benefits. While these ideas are not inherently wrong, their practical effectiveness is limited, especially for investors with large mutual fund holdings. Many commonly recommended approaches are reactive, implemented only after markets have already declined. In addition, the alternative assets suggested offer returns that are simply too low. They may be more suitable for people who already have a lot of money. Low returns are an underestimated risk for long-term investors. A more relevant question, therefore, is this: are there strategies that can both reduce risk and enhance returns? The answer is yes, and that is the focus of this video series. We update this video series periodically, so make sure to subscribe to this channel for regular updates. Channel subscribers can email us at qeinvesting@gmail.com to request unlisted private videos or playlists at no cost. A multifaceted approach to protection. When it comes to protecting mutual fund investments, there is no single best method. A practical approach is to use a combination of strategies. To understand the rationale and details, we must first clarify several key concepts. We begin with the next topic: protection with cost versus protection with credit. What is protection with cost? Buying put options is a common way to protect against downturns in stocks or ETFs. This is the simplest example of protection with cost. While effective, option premiums can be expensive. Over the long term, repeatedly paying these premiums can significantly erode total returns. What is protection with credit? An alternative approach is to sell call options on a stock or ETF, either in the money or out of the money. The premium received can help offset losses during market declines. This is the simplest example of protection with credit. Note that a typical mutual funds does not have options, so we have to sell call spread on a highly correlated ETF. While selling calls generates income, it does not provide the same level of protection as buying puts. Selling calls also cap the upside of the investment return. In practice, we use both methods in combination rather than relying on just one alone. Direct protection versus indirect protection. On this channel, we present various strategies designed to enhance mutual fund returns. The Weekend Delight strategy, discussed in the video Weekend Profits, a smart strategy for stock and options trading, is one example of an indirect protection strategy. Indirect protection focuses on allowing total combined returns to outgrow risk. By consistently enhancing returns, investors create a larger financial cushion to absorb downside risk. This approach enables growth with controlled risk, rather than simply attempting to avoid risk altogether. using the market's money for protection, and making proper use of margin power. If protection must be paid for, why pay entirely out of pocket? A portfolio can be structured so that the market effectively pays the insurance premium. This is not a scam or a gimmick. The cost of protection is actually paid by giving up a small portion of upside potential. Another important concept is margin power, a resource many investors overlook. Margin power often sits unused in brokerage accounts. When it is used thoughtfully and responsibly, margin power can be an effective tool for both risk reduction and return enhancement. Correlation matters. Mutual funds differ in market behavior and correlation. Some are highly correlated with the NASDAQ 100, while others are less so. In this video series, we use QQQ and TQQQ options to illustrate mutual fund protection methods and strategies. Illustration using QQQ and TQQQ. As of January 2, 2026, QQQ is trading around $613 and TQQ around $52.30. The implied volatility for the week ending January 30, 2026 is approximately 20% for QQQ and 57% for TQQQ. For mutual fund protection, we generally prefer using options that expire in the last week of each month. Suppose we want downside protection if mutual funds decline by 2% or more. This corresponds to QQQ falling from $613 to approximately $601. A $601 put costs roughly $6.90, or $690 to buy a contract. To reduce this cost, we can sell a $588 put for about $4.40 premium against the long put at $601. The $588 strike represents a 4% downside move. This creates a put spread, reducing the net cost to approximately $2.50 to own this spread. To further offset the cost, we can sell a call spread at the $638 strike for about $2. The $638 strike is roughly 4% above the current price. After adding the call spread, the net cost of the entire protection structure is reduced to about 50 cents or less. At this level, protection becomes far more affordable. Therefore, it is practical to apply it in protecting a larger mutual fund holding and protecting it more frequently. The latter means that we can make the mutual fund protection as a routine part of the investment process. Adding TQQQ as a companion for mutual fund protection. If one tool works well, why not combine it with another? QQQ has a leveraged counterpart, TQQQ, which provides 3 times leverage. Its implied volatility of approximately 57% will provide in substantially higher option premiums. TQQQ and QQQ are effectively 100% correlated. Together, they can form a combined profit and defense framework. Premiums generated from TQQQ options are more than enough to fund QQQ-based protection. In turn, we can use QQQ options to protect TQQQ's risk exposures. When used together, QQQ and TQQQ can provide effective mutual protection at little to no net cost. In fact, it is possible to use them jointly to enhance returns. It is worth noting that TQQQ underwent a stock split in late 2025, which may reduce its effectiveness for certain return enhancement strategies. In the video, Weekend Profits, a smart strategy for stock and options trading, we present weekend trading as an effective tool for return enhancement and can be used for indirect protection. More effective indirect protection strategies will be introduced as this channel continues to grow. Another important question is, how many protection methods or positions should be used? In principle, more can be better, especially if they are low cost or free. However, they should not distract the core investment process. Over the long term, growth can outweigh risk when managed properly. Closing thought. Protecting mutual fund investments is not about avoiding risk. It is about planning for it. By combining cost-effective protection and proper growth-enhancing strategies, investors can build portfolios that support long-term compounding with reduced risk. This principle is a cornerstone of the quantum edge approach. We hope you find this video informative and useful. Please give us a thumbs up and subscribe to this channel for anytime access to this and other videos. As a subscriber, you can request private videos or playlists by emailing us at qeinvesting@gmail.com. That's all for today. Thanks for watching and catch you in the next one.